Don't ever refinance again. You're just pouring money down the proverbial. That's right. It's very seldom that I recommend someone refinance their mortgage. Let me quickly tell you why. My goal in my own personal finances is to act like a banker and not a borrower. Yours should be as well. And I base this on the fact that those who understand interest earn it, and those who don't are destined to pay it. It's an obvious question, isn't it? Now, I know that rates are down in the fours, but they weren't when I first made this PowerPoint presentation up. But it really don't make a lot of difference where rates are when you understand what's going on. The sign on the left is based on consumer rates, which is what you see in the news and on the financial shows and in the paper and in all of the ads from the major banks and mortgage companies. On the right is what's called the effective rate. Now, the one on the left, that's based on the money you pay to the bank for borrowing the money. The one on the right is the money you pay for the bank or pay to the bank for borrowing the money. Sounds similar, doesn't it? The difference is the length of time that you have the mortgage and how much interest you actually pay over that period of time, and that changes that rate to what's known as an effective rate. Now, here's the things that the bank knows. We refinance every 5.1 years, it's a national average. We sell every 7.4 years, a national average, and less than 10% of the U.S. homes are ever paid off. These bullet points are what people in the mortgage, banking, and financial and real estate industries know and base their sales approaches on. Read this slide over carefully. You know, and I know, that $31.41 or 40 cents a month wouldn't stop you from buying a house if you really wanted that house. Every one of the businesses I mentioned on the previous slide know it too. They all want to sell you on a mortgage or a refinance. Did you know that the banks make about 87.5 cents on every dollar you pay them the first 7 to 10 years? Now, basically, what I'm telling you here is that this loan is a $100,000 loan based on 5.5%, which is in the sign. And if you took that monthly payment and bumped it to a 6% interest rate, that would change that payment by $31.40 a month. But at any rate, at 5.5%, if you borrowed the amount of money that's in the left-hand column and you paid it off over the 30-year period, you would pay what's in the right-hand column. You see, bankers focused on the interest dollars they've got coming in. Consumers focus on the interest rates they're paying out. So it does get worse. If you refinance your mortgage in 5 years, assuming that you have a $100,000 loan and you want to do a rate and term refi, which the new rate is, say, 4.75%, this is what we have. Your initial loan was $100,000. Your payment for principal and interest was $567.79. And after 5 years, you'd have a balance of $92,461. In other words, you would have paid off $7,539. Now, if you want to refinance, you're going to have closing costs of approximately $3,000. Your new loan balance, once you roll that $3,000 into it, would probably be $95,461. And your new payment now would drop to $497.97, or a monthly savings of $69.82. Now, your parents Some of those bankers, your financial advisors, all of the big gurus in the business are going to tell you that the way to find out how well you're doing with that is to divide the total closing cost with the monthly savings, and that'll tell you how many months it's going to take to cover the cost of that refinance using the lower payment. I'm going to tell you it's wrong. It equates to 433.3 months, 35.25 years instead of 30. You made $34,607 in payments over those first 5 years, right? Who has that $34,607 if you refi? You or the bank? Now you know why it's hard to get ahead. As your lender, your banker, your realtor, your CPA, financial advisor, have any of them shared these facts with you? And always wonder, if they haven't, why haven't they? And to me, it seems like there's only two reasons. Number one, they don't know. And number two, they don't care. Either way, I wouldn't want to do business with anyone who fell into these two categories. Would you? So here we are, debt-free in 6.5 years. So why would you want to pay on a mortgage 30 years when you're probably going to refinance every 5 to 7? I'm talking about debt-free in 6.5 years. It's yours. Why refinance to 15 years? That's to shorten up the term and supposedly pay off less interest, but your payments are higher. Your interest rate, your closing costs. Why not just be debt-free in 5 to 7 years to begin with? Why not put that money in your pocket? These are just a few of the questions that you need to get answers to before you think about even getting a mortgage, let alone before you think about doing a refi. And let them lure you into the thought of lower rates and how much money they want you to think that you're saving, when in fact you're not. So here's my information if you have questions. I'm sure that a lot of you do. There's no cost or obligation to talk to me. And I think that ought to be obvious after watching this video. It's pretty blunt, it's pretty straightforward, and it's put there in your interest. Thanks for watching.